Recently, the US dollar experienced its worst first-half performance since 1973, dropping over 10.8% against major currencies, which has sparked discussions about de-dollarization. This video explores the economic factors behind dollar's devaluation and examines the prospects for the US economy and its geopolitical impact and World War III. There are a lot of interesting topics with hidden nuances to economics and geopolitics. We request you to watch the full video. Namaskar, welcome to Geopoliticonomics. The first half of 2025 recently ended with an unfortunate record for the US dollar, marking its poorest performance since 1973, the year when the Arab oil embargo hit the dollar hard. To grasp the situation, let's examine the dollar index (DXY). In January 2025, the dollar index was around 110. By the end of June 2025, it had dropped to 96.72. This represents a significant decline of minus 12.1% in the dollar's value. The dollar index measures the dollar's strength against a collection of major global currencies. This is further demonstrated by the corresponding exchange rates, with the USD-EUR and the USD-GBP reaching 42-month lows, highlighting the dollar's struggles. Why is the US dollar weakening? In general, three factors can be credited with the dollar's decline. 1. Trump trade policies. On April 2, 2025, President Donald Trump rolled out sweeping tariffs starting at 10% on all imports, rising to 20% on EU goods, 34% on Chinese products, and up to 46% for select countries. His aim was twofold: generate up to $600 billion in annual revenue and spur a domestic industrial renaissance by incentivizing onshore production. Initially, the announcement strengthened the dollar, signaling a protectionist US policies that boosted investors' confidence. However, reciprocal tariffs led to supply chain disruptions and rising inflation, undermining the dollar's stability and fueling prolonged global tensions. Supply chain disruptions create production disruptions, leading to artificial scarcity and the corresponding rise in the prices. Trump proposed striking 90 deals in 90 days as a solution to this by July 7th, but only the UK and the Vietnam have signed the pact so far. India is working on finalizing its trade agreement with the US, but as of the time this video is being made, there is no update on its completion. 2. Investor flight from dollar assets. Foreign investors, including central banks and pension funds, are reducing exposure to dollar-denominated assets. This retreat is driven by concerns over rising US debt. The current US debt stands around $37 trillion. The US debt to GDP ratio is currently around 124%, meaning the total nominal debt is 24% of the country's gross domestic product. This means the US debt is significantly larger than the total value of goods and services produced in the country in a year. This high debt-to-GDP ratio can pose challenges for the US economy, potentially leading to higher interest rates, inflation, and decreased investor confidence. Why does higher debt and inflation lead to currency devaluation and weakens an economy? Rising sovereign debt of a country increases the risk of investment. As a result, investors demand higher interest yield for their bond investments made in the US T bonds in this case. The US government is paying close to $1 trillion just as interest for its high sovereign debt. Interest rate parity principle states that any difference of sovereign interest rates, indicated by treasury bond rates, is reflected in the currency value differentials. Say, the US is having a higher interest rate than China. This difference is reflected in the lesser value of USD against RMB. Purchase power parity principle (PPP) states that any difference of inflation is reflected in the currency differentials between the two economies. Say the US is having higher inflation than China. This difference is reflected in the lesser value of USD against RMB. Both are interlinked to each other. Political interference in the monetary policy. The Federal Open Market Committee (FOMC) kept the federal funds rate at 4.25% to 4.5% for the fourth consecutive meeting, maintaining a pause on the interest rate cutting cycle that began in September 2024. President Trump, a critic of Fed Chair Jerome Powell, has renewed his attacks, calling for Powell's resignation and labeling him a very stupid person. Trump is urging the Fed to cut the interest rates by up to 2% points, even though the inflation remains above the Fed's 2% target. This is logically illogical. The tussle between the federal government and the Fed is shaking the investors' confidence in the US, leading to declining confidence in the USD. 3. Geopolitical tensions, diversification, and gold run. The USD reflects trade, flows, and the economy, indicating business and investor confidence. The US economy accounts for 25% of global GDP, with 54% of global exports in US dollars. Additionally, 60% of bank deposits, 70% of international bonds, and 57 to 60% of central bank reserves are in USD. The global trade and financial system's reliance on the USD is now being questioned. Central banks worldwide are shifting away from the US dollar and increasing their gold reserves, signaling a trend of global diversification and a potential decline in the dollar's dominance. The gold rush is driven by geopolitical tensions, inflation risks, and a desire to reduce reliance on a single currency. Clearly, countries are losing confidence in the USD. This is fueling the de-dollarization. Dollar devaluation, implications for the US economy, and World War III. The global dominance of the US can generally be divided into two types of power: soft power and hard power. The US soft power is rooted in its economy and the USD. It has used economic sanctions, leveraging the dollar's dominance over the SWIFT system. A weak dollar signals a weak economy. Dollar devaluation and the emergence of alternatives like BRICS pay and bilateral currency swaps threaten the soft power. The United States' hard power lies in its advanced defense technology and military strength. It remains the world's military superpower without question. Should the US entirely lose its soft power, such as through complete de-dollarization, it may be compelled to rely on its hard power, potentially leading the world into World War III. This could shift the US from being a superpower to becoming an imperialistic power. Again, there are a lot of subjective factors which might affect this transcendence. What are your thoughts on de-dollarization? Do you think World War III is inevitable? Let us know in the comments. If you like the video, please like, share, and subscribe to our channel. Don't forget to press the bell icon to receive further updates. Thank you so much for watching.